Okay, so in the Bitcoin world, there's one company that's gone all in. I mean, all in. We're talking about a publicly traded software firm. We'll just call them Strategy. And they've bet their whole future on crypto. They've piled up such a massive hoard that it's actually starting to shake the entire market. And that leads to the big question on everyone's mind. Is this company now too big to fail?
I mean, seriously, think about it. What happens if they get into trouble? Could a crisis at just one company really set off a domino effect and take down the whole crypto market? Well, that's exactly what we're going to dig into today. All right, first up, let's get our heads around just how big this bet really is. This is not some casual investment, you guys. We're talking about a $60 billion gamble, all on a single asset. And here's the number that'll blow your mind. Strategy holds 650,000 Bitcoin. Yeah, just let that number sink in. That makes it one of the largest, if not the largest, corporate stashes of Bitcoin on the entire planet.
Now, to put that into perspective for you, 650,000 Bitcoin, that's 3.1% of the entire supply that will ever exist. Think about that. One single company controls over 3% of the whole asset. That gives them an absolutely massive amount of influence over the market.
And that influence, well, it's being put to the test right now. Bitcoin's price has been dipping, and as a result, Strategy's stock took a 30% dive in just 1 month. And you know, a drop that big has a lot of people connecting the dots, and it's sparking some real fear about how stable this company actually is. And look, this fear isn't just coming out of nowhere. Financial history is basically a graveyard of giant companies that seemed totally invincible, right up until the moment they collapsed. Which raises a pretty unsettling question, right? Could Strategy be next on that list?
You know, as corporate lawyer Eli Cohen says so bluntly, public companies can, and they do, completely implode. No one is invincible. History is just full of these stories of giants that have fallen, and fallen hard.
I mean, just think about Enron. For a while, it was the 7th largest company in the US. Or what about Lehman Brothers? Their collapse kicked off a global financial crisis. Both of these were considered absolute titans, and yet they imploded. It's a pretty sobering reminder that big definitely doesn't mean safe.
And you don't even have to go digging through history books. I mean, just look at what happened recently. We saw Silicon Valley Bank, Silvergate, and Signature all go under. These are all public companies that went bankrupt, completely wiping out their shareholders. So yeah, this is a very real, very modern risk.
And hey, this isn't just a problem for the old-school finance world. We all remember FTX, right? It was a giant, an untouchable pillar of the crypto industry, until suddenly, it wasn't. Its collapse was a painful lesson that in this space, absolutely no one is immune to a catastrophic failure.
Okay, but that's just one side of the coin. There's a really strong counter-argument out there that says Strategy is built differently, that it actually has the resiliency to get through this storm. So, what's the case for its survival? Well, the thinking kind of goes like this. Strategy is a major, publicly traded company. We're not talking about some fly-by-night crypto project here. It's got a huge market cap, and because of that, a lot of people believe someone would have to step in and bail them out just to avoid the fallout of a total collapse. An expert, Mitchell Rudy, even suggests that the company's sheer size gives it a kind of inertia, you know? It's just so big that it can power through all the FUD, the fear, uncertainty, and doubt, that would probably sink a smaller company. But, and this is a huge but, here's the crucial counterpoint. That whole bailout theory, a lot of experts are really skeptical. See, unlike the big banks back in 2008, Strategy isn't all that connected to the traditional financial system. One analyst put it pretty bluntly, no one will bail them out. They might just be on their own.
And this leads us to what a lot of insiders think is the real danger here. It's maybe not a sudden, dramatic, Enron-style implosion. It's something slower, something a little more sinister, a liquidity crunch.
So what the heck is a liquidity crunch? Well, to put it simply, it's when a company starts running low on cold, hard cash. They can't pay their short-term bills, and that pressure forces them to start selling off their most valuable assets to raise money. And in Strategy's case, well, that asset is Bitcoin. Okay, so here's how this could actually play out. Step 1, the stock price keeps falling. Step 2, this puts a huge strain on their cash reserves. And then Step 3, shareholders who are watching their investment just plummet start putting massive pressure on management to do something, anything, like say sell off their Bitcoin to fund stock buybacks and get that price back up.
And this, my friends, is where the drama really heats up. Because the founder of Strategy, Michael Saylor, he's built his entire philosophy, his entire public persona around one simple, unwavering mantra: never sell your Bitcoin. It's not just a strategy, it's the core of their entire identity.
And yet, despite that rock-solid stance, the pressure is so intense that the company has now gone public and admitted that, yeah, they might actually be forced to sell some of their Bitcoin. Now, that admission sent absolute shockwaves through the community because it's a huge signal that this threat is very, very real.
Okay, so to stop this worst-case scenario from happening, Strategy has been preparing. They've basically built a war chest for themselves, a massive cash reserve of $1.44 billion. And it's designed specifically to fight off a liquidity crunch so they never, ever have to touch their Bitcoin.
So when you take all of this, the sheer scale of their holdings, the scary historical precedents, the internal financial pressures, it all boils down to one final and potentially market-defining question.
And it really all comes back to that number, 3.1%. Because when you hold that big of a slice of the entire pie, any sale from you isn't just another transaction. No, it's a huge market signal, a signal that could trigger widespread fear.
You know, experts are warning that the second strategy even hints at a sale, traders are going to try to front-run the news. They'll start selling, they'll start shorting Bitcoin, all to get ahead of the price drop they know is coming. And in a market that's already nervously looking over its shoulder for the next FTX, well, this could just pour gasoline on the fire.
So that leaves us with the billion-dollar question, doesn't it? The question that's hanging over the entire market. What happens to Bitcoin, and more importantly, what happens to the confidence of every single investor out there when the biggest, loudest, most die-hard believer is finally forced to sell?